And we are live, guys, today on Tuesday with the one only Peter Carlin. I mean, this is Pete. This is the fourth time you're here?
I think so. I think it's the fourth time, right?
This is the fourth time in a row. So it's really special because
I am honored, though.
we
to be
rarely
invited back over and over.
We rarely invite somebody over and over and over again. So Pete, every time you come, you bring value, you bring fire to the table, and the agents and the people in general, they always learn a lot from you.
Awesome.
So I really appreciate you really taking the time to come over here to Bayside. So guys, you better buckle up because today we're gonna talk about outside the box loans, non-QM loans to be specific, stated bank statements, right? No income checks, really the loans, which we need sometimes.
Yes.
And there's only very few lenders which actually has those loans and know how to get those loans down. I know we're also going to talk about the 3-2-1 buy down, where buys today, you don't have to get 7%. You can get 4%. And you know what? That's a big value. So I hope you got the notepad ready with a pen and start taking notes, because this stuff is going to help you close many more deals this year. So I'm ready. You guys ready? And as always, this is on Facebook, YouTube, and all that good jazz. So if there's any questions, just shoot it out and we will either answer it live or we'll go back to it and we're going to get you those answers. So Pete.
John.
The space is yours, my man.
Thank you, brother. Appreciate you.
Take it over.
Appreciate you. Thank you. All right, guys. So I will start with what we call non-QM. It's called non-qualified mortgage, right? Which is outside of your traditional mortgage. Traditional mortgage, of course, we're talking about showing tax returns, pay stubs, W-2s to show tax returns, to show how the income, right? But there are a lot of people, especially I find in the New York area, right, that are doing either they don't show the income, right? A lot of self-employed. It's the self-employed, right? So what typically what I see is a self-employed person who shows a lot of gross sales, right? They show the gross income, but then they take all these deductions and they end up with very little net income. And the net income is what we use in the mortgage business to qualify you for income, right? The net income.
Now, just out of curiosity, right? Because I know you are closing a lot of loans. You're super busy. What percentage would you say are the outside the box, the non-traditional loans? I'm not saying you're doing those, but how many customers they come to you and say, "Hey, P, I'm not showing you income, or I have a business but I have too many write-offs." Like, how many would you say? 10%,
I would say
20%?
I would say almost 30%.
30%.
Yeah. I would say a lot of the folks now there are a lot of folks who are self-employed who do qualify, right? There are a lot of folks who are self-employed who do qualify. So let me just turn this off. I apologize.
So I mean, guys, keep in mind, what that basically means, that you can close 30% more deals because you're going to have access to these loans with Peter Carlin. So instead of you selling, 100 homes a year, you can easily sell 130 homes a year because you just didn't have the right product for your customers.
And it also, of course, depends on your marketplace, right? I think, right? I think you'll attest to it as well. In the New York, Queens,
Long Island,
Long Island, we see so many. We have a lot of self-employed people.
That's right.
Hey,
we are city of entrepreneurs, right? This is the Empire State, guys. Keep that in mind.
That's true. A lot of people come here to start businesses, right? I mean, we have a lot of folks. So we do get a lot of mix. So people come and they say, well, I don't have enough income to qualify. They have the credit, they have the money in the bank, but they don't have the income. Now, I will say this, that sometimes, especially now, it's the beginning of the year and people are filing their new tax returns, right? I I can never tell somebody what to do, with regard to income. I can't do that, right? However, if people take less deductions, your income is what your income is, but if you take less deductions, you'll have more of a net, and it's all about the net, right? So
For
it's
self-employed.
for self-employed,
Okay.
right? For a W-2 person, it's W-2. It's what they're showing on their W-2. Why? Because that W-2 income, we know the taxes are taken out. We know that after the taxes are taken out, that's what they end up with.
It's considered more stable income in a way, you can say.
It's more stable in the sense that we see the deduction. I mean, the deductions are, your 401k, your health insurance, all the taxes. It comes out. We know what the net is, so it's sort of more stable in that sense.
And I also think, if you're an employee, and let's say you are a teacher, right, or you work for the NYPD, we know that your income might go up a bit.
Correct.
But it's not going to go down.
Right. Rarely do we see somebody's income go down who's W-2. Right?
But on the other hand, with self-employed, we know that, given the market conditions, you might have a good year where you might make, $150,000.
That's right.
But there might be some, different scenarios which is going to affect that.
Right.
I don't think banks are usually more cautious.
Yes. And we want to see, most mortgage companies, most mortgage banks want to see 2 years of stable income, or two years of a business, right? You got to be in business for 2 years showing some stability. Now, what we'll do typically when we look at tax returns on a business is we'll look at an average, assuming that the net goes up, it's increasing from the prior year to the current year. We'll average the 2 years. If the net went down, we'll want to know why it went down, and we'll look into that and we'll ask you, but we'll also take the current year because it's lower, right? You have to be conservative. But we are looking for at least 2 years. And then for those folks who have been in business for 5 years or more in the same line of work, in the same business, in the same industry, we can do a 1-year tax return, which is super cool. Yeah, so the most recent. That's right. So we can, right? If you've been in business for 5 years, the government says, well, they have a program, right? They have programs that say, okay, because you've made it for 5 years and you've been in business for 5 years, we'll let you do frequently, right? It depends on what the findings say, right? When I say findings, we have a automated underwriting system called AUS. If the findings say 1 year, we go 1 year. Now, LP, which is Freddie Mac, I'm not going to get too deep, but Freddie Mac, it defaults 1 year. It's 1 year.
Automatic.
Automatic. For Fannie Mae, you have to see what the findings say.
Now, let's just say, you have a person who has multiple businesses.
Yes.
And some of them he's been having them for longer than 5 years.
Yes.
But some of them he's been having less than 5 years. Are going to take the ones which are less than 5 years, or they're going to compare it? So you have to look at all of it, and you can't, from an underwriter that told me last year, actually, you can't mix and match. You can't mix and match. You're either going this way or you're going this way. So in that case, and that's a great question, I'm actually gonna, you know what? I'm gonna ask again, okay?
Because I was told by a very respected underwriter, head underwriter, you can't mix and match. So if you're less than 5 on one, but more than 5 on others, you can't look at one on this, and you got it.
You look at a worse.
You got But I'm going to double check that. That's a great question.
Do they consider an LLC? Let's just say, you might have a property and you put into the LLC and you just bought it last year, right? And you have multiple properties and you have a business which is longer than 5 years now. Are they going to look at the LLC being younger than 5 years? That's a great
question. So if the LLC
business,
if the LLC has been around for 5 years, no, that's 5 years.
But if it's less than 5 years, and then you have, let's say, corporations which are longer than 5 years, because maybe you just bought the building last year, maybe a couple of years ago.
But it's not about if if you have multiple buildings under the LLC that's been around for 5 years, it's a great question. I'm going to tell you, if that business has been around for 5 years, you can do a 1 year. You can do a 1 year tax return.
That's
Yeah,
great.
yeah,
That's great.
that's really cool. Actually, no one ever asked me
Yeah,
that before.
I tried to ask. I tried to give a hard time to Peter. I
Why
tried to
not?
come up with questions which no one has the answers to, and it's kind of what is this channel about, to really get you the answers
Really,
where you
yeah.
can't really find anywhere, not even on Google. But this is streamed on YouTube, so you can find it on YouTube.
I don't know everything, but I know a lot, and
Yeah.
I've had some really great mentors, and
Yeah.
teachers in my
Yeah.
career. So
Yeah.
thank God. Yeah,
So,
yeah.
Take
All
it
right,
away.
brother.
I'm
Thank you.
out.
You can pop in if you got.
Yeah, I'll pop it in
You'll
if I
pop
have
in.
to, guys.
So non-QM. So when we say non-QM, again, non-qualified, right? There are different types of, when we say no income check, there's always something in lieu of income. Something in lieu of income. So for instance, we have a bank statement program where we look at your bank statements, your deposits on your bank statements for a period of 12 or 24 months, 12 or 24. And we look at the deposits, the business related deposits going into the bank account. And we take an average of those deposits either over a 12-month period or a 24-month period. And then we multiply that by an expense factor. Okay. The default expense factor is 50%. So let's say your average deposits are $20,000 a month. 20,000 a month over 12 months or 24 months, and then you take a 50% expense factor. Now the income would be $10,000 that we would be able to show for that person, right? So it's an alternative way of looking at income, right? We also have another loan, which is a P&L with two bank statements. P&L, what does that stand for? P and L. Profit and loss. Okay. A profit and loss prepared by, typically we want to see it prepared by a CPA or an accountant or a tax preparer. But sometimes we have some programs where the borrower can do the P&L, right? And we have to show two bank statements that back up the P&L. So you can't just, and I'm talking about one particular program, you can't just make up numbers on the P&L and then have no bank statement, bank deposits to back up that P&L. Okay, that's one program. By the way, let me say something. When we talk about these non-QM loans, you're getting a higher interest rate, whether you like it or not. Right? I mean, that's part of the process, right? Because you're basically not showing tax returns and pay stubs and W-2s to qualify. So you're really more of a risk to the bank, and the bank says, hey, for that benefit, because you're not showing the traditional paperwork, we're going to hit you to the interest rate. So what's the hit to the interest rate? It's typically 2 to 3% more of what the current prevailing rate is, about 2 to 3% more. And it could be even more depending on the program, right? So there's, I told you about that P&L program. Then there's just a P&L, right? Where you just have to have the money in the bank, and you could do a self-prepared P&L. Now that rate is higher than the other rates, right? So there's different, right? So there's the P&L, there's the bank statement, there's a debt servicing program. So now if you're an investor, if I'm doing this right, this particular loan right now for somebody, if you own a property and you buy a new property as an investment, by the way, most of these programs all require at least 20% down, right? Higher risk, the bank want to see that you have the money to put down at least 20%. I have a lot of people that say to me, oh, can I do 5% and don't show any income? No, it doesn't work that way. That's way too much of a risk that anybody wants to take on. So, okay. So now we have the P&L. I told you about the P&L. Okay, 20%. And you also need to have good credit, right? It's very important to have at least 700 credit, at least 700. Better to have 740. And credit, by the way, in every loan instance that I'm aware of has an impact on your interest rate. Okay. So it is so important to keep your credit clean. And if you haven't seen your credit for a while, I highly suggest at least once a year. At least once a year. You can use annualcreditreport.com. You could use, I think it's myfico.com. Also Smart Credit. If you use Smart Credit, I have if you get in touch with me, I have a promo that I could send you from a buddy of mine who's a credit repair expert. It's $1, charges $1, gives you all 3 credit bureau scores for a 7-day trial period. So normally
great software. I actually using it with Travis.
Oh, yeah. Exactly. Travis, my man Travis, great credit repair guy. If you guys have issues with credit, Travis does amazing stuff. And you need to go, you want to stay with a banker, you want to work with a loan officer that has people like, these credit repair people that I have access to, people, good attorneys, has a whole team of people that can help you with stuff. Okay. So, we're talking about credit, talked about, at least 20% down, bank statement. Let me just take a look at my slide here. Okay. By the way, let's read. Okay. I sort of told you a non-QM loan does not meet all the guidelines. This is the official definition. Does not meet all the guidelines set forth by the CFPB, the Consumer Financial Protection Bureau's rules. Typically, borrowers who qualify for this loan type have higher debt-to-income ratios, interest-only loan programs, which we have, and irregular income. Non-QM loans provide greater underwriting flexibility, allowing homeowners access to more financing solutions. Okay, I spoke about the 12 or the 24-month bank statement program. I spoke about the profit and loss in 2-month bank statements. Now let's talk about the debt service coverage program. So the debt service coverage program is for someone, as I said, who owns a property already and they're buying a property as an investment. I'm doing that, as I said, with somebody right now. Here's how that works. Typically, if it's a 1.0 ratio, 1.0, the rent coming from the proposed units of the house. If it's a 2-family, you got 2 units, not the basement, only what's legal. So although if the basement is part of the first floor, then you can get the rent for it's for 2 floors, right? So you get the legal rent that's given and dictated by the appraiser. It's not by you, it's by the appraiser.
What about if there's a lease and there's an extra tenant? Are they gonna pay?
Yeah, you gotta go with that's a good question. You gotta go with the tenant that's there. Yeah. Okay. So if you have one, you got a tenant in and another one vacant, you go with those 2, right? So it's the rent that you're getting has to cover, if it's a 1.0 ratio, the rent has to cover the mortgage payment, the cost to carry. And if it does, we're not looking at any other income.
Wow. And I mean, that's for investor. Now, I put my investor hat on. I mean, it should always cover it. As a matter of fact, you should get a cash flow. You should get extra money on top to cover your utilities, your vacancy, your maintenance, a property management. And you know what? Hey, where's my profit at? Right? That's got to go on top. So I think it should always cover. So I mean, that's a great.
But let me tell you. So I'm going to give you a situation that I have right now. I have these gentlemen who are putting down 40% on a $1.27 million 2-family. Wow. 1.27 million 2-family. They're putting down.
We can help them find better investments for sure, man.
Well, they happen to own other homes right around that block.
So they make it emotional.
So it's like. I hope you guys are not listening to this. No.
No, I mean, they gotta listen to this because you know what? When you invest into real estate, it's gotta make sense money wise.
Yeah.
Because why would you be partying money somewhere? It's to multiply and make you more money besides the
well, I don't know what plans they have. And listen, there is a basement, there is a driveway, there's
you can depend on that. That's the bonus.
I know.
Yeah.
But I hear what you're saying. But anyway, it's 1.27 million, 40% down. the mortgage payment is going to be about with taxes and homeowners insurance and everything included is going to be about $5,900.
Yeah.
5,900. So I'm banking, we're all banking that the rental income is going to be at least $6,000 from the whole house, right? So to cover that mortgage, right? What's that?
Where is this house?
This is I believe it's in East Elmhurst.
Okay.
It's in East Elmhurst. And listen to
1.7.
1.27.
1.27.
1.27.
Right?
It's either Woodside or East Elmhurst, something like that. 2 family. Yeah.
Family.
Yeah. Yeah.
Maybe the zoning supports something that we might not know.
No, that's the going rate. That's the going rate in the area for
Yeah.
the family.
Now listen to this deal. I feel really good about the deal that I'm getting them.
That's why I don't invest in East Elmhurst and Woodside.
7% interest rate.
Woo!
Woo!
Wow.
Did you hear that? 7%. It's an ARM. It's an adjustable rate. It's a 5-year ARM. However,
That's supposed to be a good rate, 7%.
Yes.
on a
Investment.
2-family
Non-QM.
investment, non-QM, no tax returns, nothing.
Yeah.
That's a phenomenal. Please, Monica, tell
I
them.
think quoted me like 5 and change for an owner-occupied FHA.
Oh my God!
And you got to pull the hair out of your head to put the paperwork together.
Forget right. So
The other thing about the non-QM loans is they're a lot smoother, right? From a point of view.
typically,
from
yes,
a point
you're
of view
not
as a consumer,
so much
you have
less
to submit
documentation.
documents,
So much less
less
documentation.
questions, a lot faster,
And here's the other thing I tell people, like I told these guys, I said, listen, right now, you don't have the income. They're business owners. They have a few properties and they have a few businesses, but the businesses aren't showing enough income. So I said, listen, you wait a year, hopefully your businesses are going to do better, right? You'll file better income on your tax returns, and then you refinance out of this rate, right? You refinance out of this rate, which is not bad for you could, listen, and here's the other thing I want to tell people. People think frequently when they hear ARM, when they hear adjustable rate mortgage, oh, no, not for me. No, I need that 30-year fix.
Yeah, but I'm going to hold the house for 3 years only, but I want 30 years just to, because everybody else doing it.
Typically, but also people think, listen, you have to look at the time that you're in. Right now, the interest rates are higher than they normally are. Well, I don't want to say normal.
Recently.
They were higher than they've been, right? I don't want to say normal. I want to say they've higher than they've been because we went from COVID really low and we went up higher, right? So people are like, oh my God, 5, 6, 7. Oh, that's a lot. Okay. Within inflation's high, right? Rates are high and unemployment is low, right? So when things change, unemployment gets a little higher, inflation comes down, rates are going to get better. There's going to be a whole refinance boom within the next couple of years.
Oh, yeah.
There's going to be a refinance boom. So take your 7% now, take your 8% now. It's a hard pill to swallow. I get it, but you're going to get out of it. You're going to get out of it. Right? So take the rate now, get the property that you want, get into the property that you want. Because by the way, when the rates do come down, home prices are going to fly through the roof.
Oh, yeah.
Okay.
Oh, yeah.
You heard that.
I'd rather take a low price at a higher rate over a high price and lower
Of
rate.
course.
And you know what? End of the day, it's not even about the rate. The numbers has to make sense about the monthly payment.
Of course. So it's okay, right? ARM's not bad. And I'm going to talk to you guys momentarily about the buy down, right? It's a temporary buy down. You're temporarily buying down the rate for the time being so that you can then later on refinance out, right?
No.
You're watching?
Yeah, no.
Oh, Josh Kellerman.
We
what's
good.
happening,
What's
brother?
up, Josh? Good to see you.
Miami. We're
Miami
coming.
guy.
We're coming.
He's on
We're
the
coming
way.
to join
Look
you,
at that.
man. We're coming. You didn't invite us.
You do loans in Miami too, right?
Yeah,
Exactly.
we come to
Exactly.
Miami, man. Let's get a following down
He's
there.
looking for a condo. Well, by the way, in Canada, they don't have 30 years fixed loans.
They don't have what?
They don't have 30 years fixed loans.
Oh, isn't that interesting?
All what they have is 5 arm, 3 arm, 7 arm. Yes, yes. And you know what? The rate is like 7% too
Wow.
for a private residence.
Wow.
Private
Wow.
residence. So really, 30 years fixed. I think it's only in US. You have 30 years fixed.
Interesting.
You go to Europe, they do arms as well. They don't give you loan for 30 years fixed. I mean,
Do you think 30 years is a good thing?
well, if you're an investor, I don't think so. Because I don't think you should hold the property longer. Me personally, I don't think you should hold it longer than 3 years. Because you want to step up. You want
Look
to
at
step
that.
up
3
the
years,
basis.
he says, hold the property.
You want to step up the basis.
Now-
You know, my dad, right? My dad, he was under the strategy: you buy, you never sell. You buy, you never sell, right? But what happens as the value of the property increases, the return on that equity, because the equity grows, the return on equity increases, right? So you're actually really limited. Well, you got to sell it and you got to put it into something bigger. So now it can grow again, and you can get a higher cash flow, and you can get a more depreciation and stuff like that. So yeah, you should never hold investment for
Isn't that
longer than 3 years.
interesting, huh?
Interesting concept.
Yeah.
That's really interesting. Here's the other thing about an arm, right? If we all believe, or we're saying, or my, mortgage peers believe, and experts in the industry believe that rates are coming down when inflation comes down, when an adjustable rate mortgage comes to an adjustment period, it could go lower than what you currently have.
It goes whatever the current rate is, right?
It's tied to an index. It's tied to an index, like the treasury rate, or the overnight lending rate, or the prime rate, right? It's tied to an index. So when that index drops, right, it's a margin. Adjustable rate mortgages have a margin and an index. Margin and index. Margin stays the same. Margin is like the foundation. So let's call it 2%, right? And the index is this economic index, like the prime rate, which I think today is 7.75, if I'm not mistaken. So 2 on top of 7. So, but when the index comes down, rates come down. So if you stay in an adjustable rate mortgage, it could go lower. And I've had one in the past, and my rate actually went down from where it started. So you just never know. But also, when an the adjustment period is coming, you can see where you're at and where you want to, what your plan is for the future, and you could do a refinance or not, right? There's so many options. It's not like, adjustment period happens and I'm going to be slammed and oh my God, but and there's also caps, by the way. So every adjustable rate mortgage, typically, like, there's a 2-2 cap, like 2 years on the first adjustment, 2 years on each subsequent adjustment, and 5 years on the total adjustments over the life of the loan, right? So you can't go, from a 7% to a 20%. It's just, it's unlawful. It's not happening. Okay. DSCR. We also have foreign national loans. So people who live in other countries but want to buy here, they can also get, they can purchase property for foreign national loans.
Quick question.
Yeah.
So DSCR is the 1% rule for Go Rascal, or is that like?
No, it's not Go Rascal. It's and by the way, it could be 1%. It could be 1 to 1. It could be 1 to like 1.15. What's that?
1 1/4 as well.
1 1/4, right? Like in the commercial world, I believe it's 1 1/4.
Yeah.
Right. So your rent has to be more than the expense by 25%, 1.25.
Yeah.
Right.
But do they just focus on the property itself?
Correct. We're not looking at the electricity. We're not looking at your heating
But
bill.
you're not talking about, looking at if an investor, let's say, like myself.
No, you're looking at the whole. Yes.
You're going to look at just the property, or you're going to look at the different properties as well, and my other businesses.
No. That's the beauty of this thing.
Just that one.
Just that property.
And for the commercial, is this for 6 units or more? Is it for 20 units? It's good.
So this DSCR program
The specific one
I'm only talking residential.
I see. So
right.
only a 1 to 4.
1 to 4. Yeah. Now we do have, and I just started with this company about a month ago,
Yes,
but
yes.
they do have 5. They do have 5 to 8. Different products and stuff like that.
All right.
I have to learn those products.
But no
'Cause
commercial, no 12 unit or 20 unit.
There is some stuff. But I have to get back to you on that because I don't know that yet.
But all of these are going to require at least 20%, 40%.
At least 20.
25,
At least
20,
25.
At least
25.
20.
Yeah.
And commercial it's typically at least 25. At least 25.
And are the
Residential, these non-QMs, most of them at least 20.
And are the closing costs, they tend to be higher?
No.
I don't think so. Because
No.
the title and everything.
No,
stays the
no,
same.
it's pretty much the same. Pretty much the
I
same.
mean, the commercial might be a little higher because the appraisal's higher. The
Commercial,
application
yes.
fees
Or
is
commercial,
higher,
yes.
the
Commercial,
closing
yes.
costs,
You have environmental, the
Yeah.
appraisals, right? Like $2,500,
Yeah.
$2,000, $2,500. Then we have an ITIN program, right? So people who don't have social security numbers have, right? Because they're either,
Like work ID.
What's
that? Like a work ID, work permit.
you have to be here legally.
Yeah.
You have to be here legally. So it's either a work permit or a proper visa or a permanent resident card, but you don't have a social, you have an ITIN, right? We can get loans for those folks as well. And then we also have a asset depletion. So if you have, let's say after you've paid off you paid your down payment and you have money for your closing costs. If you have, it's typically about 1.25% of the mortgage. Let's say your mortgage is $400,000. Mortgage is $400,000, and you've allocated money towards your closing costs and your down payment. If you have like 500,000, which is 1.25% more than your mortgage, which is 400,000. If you have $500,000 in the bank, then that $500,000 is enough assets to cover you, so you can get a no income check loan, right? We call that like asset depletion, right? You have enough assets to offset your mortgage.
Now, I also heard of portfolio loans. Is that a non-QM loan?
Portfolio loans, it's more if you have multiple separate properties, they kind of roll that all in under one loan. But those usually, I don't think they favorable because the way they structure it, they would basically kind of like rank the less performing property and they'll give you the rate based upon that. So sometimes they might be good, but sometimes it's not a good option.
But are they giving you the loan based off of the income from that portfolio, or
From all the properties involved. Yeah. So let's say if you're buying 3 separate properties, one is 2, one is 1, one is 4, you can do a portfolio loan where they're not going to give you 3 separate loans. They're going to put them all under one loan. That makes sense. Yeah.
Okay. Let's see. So, all right. So that's it on.
You know it, my brother, Josh Cullerman. It's all about the monthly payment. Yes, indeed.
You know what's funny? Let me. It's interesting. John just, it's all about the monthly payment. So I had a conversation with a client today, right? And the client said to me, the interest, he looked at I showed him a layout of the debt to income ratio and everything. And he looked at the interest rate. He's like, the interest rate, what? The interest rate. I said, what's the issue with the interest rate? He said, well, it's low. I said, it's low. I said, oh, isn't that nice to hear? He said, yeah, how is your rate so much lower than what another banker told me? I said, well, sir, let me ask you something. Would you prefer going shopping at Costco or your local supermarket? Where would you prefer going? He said, Costco. He said, think of me as Costco. I'm the Costco guy. You're gonna go. I'm the wholesale guy. I'm the guy. I'm in a brokerage, and not just any brokerage, but the number one volume producing and unit producing brokerage in New York State, and one of the top in the United States. So I was like, and I've been told most of my career as a banker, it's always about the payment. It's always about the payment. And you know why? Because we didn't have the rate. Because we didn't have the rate. And although, yes, I agree it's the payment. I always agree it's the payment. But now I have the rate. So I could sell the rate, right? Which is really nice because, it's tough, especially in this market. What's the first thing it's like automatic. What's the rate? What even you do. What's the rate today? What's the rate today? And I say to people, what's the rate today? It's sort of like saying, how much is the car? What's the car price today? I'm like, you want a Maserati? Are you looking for a Civic? Are you a 2005, a used, a new? What? Lamborghini? What are you looking for? Give me a scenario and I'll give you a rate. But if you're looking for a rate anywhere between, I could go as low as, to be honest, I could get in the fours on an FHA. You want to go FHA? I could get you like a 4875, 499. People are like, what? Yeah, and I could go as high as perhaps 8.5, depending on a non-QM deal. So it's all over.
Now back to the foreign national loans,
yeah.
Right? So if somebody it's not legal, he has no status, he has no green card, he has no IT, he has none of that, but he has income outside the country and he has the money to buy and desire. Can he still purchase a home and get financing for it?
Yes.
Okay.
Now, I have to look because I don't know. I've never done a foreign national loan,
Okay.
but I have access to it now. And I'd have to look up the requirements for it. But yes, if you don't have, if you can show that you have the money, you have to show that you have the money. And I believe you have to show that you've got, I want to say that you have to show that you have credit in your country, wherever you have to show some type of credit. I think
HSBC used to do those type of loans.
Yeah, we do them. I have access to, I don't know, 30 plus lenders.
Mm-hmm.
At least I think at least 30, and I know 2 of them off the top of my head that have that loan because I have actually Josh, right? Josh actually has a young lady from China who we can get a loan for. Yeah. It's you got to show the money. I think you got to show the credit from another country, and I think that may be. Oh, and I think you have to have the money. The money's got to be in a U.S. bank. So if you have it over there, you got to bring it over here, and you got to put it in a United States bank. Yeah.
The season for 2 months.
I'm not sure that it has to be seasoned. I'm not sure that it has to be seasoned. I have to get back to you guys on that.
In that bank, but you gotta show the legality of that money.
Mm-hmm.
Sometimes the banks like HSBC, they will tell you have to put money in their bank account.
Right, because it can't be ill-gotten money.
Yeah.
Right.
Yeah.
I have to.
Money.
Yeah.
Drug money or anything like that.
Yeah.
Right? It's gotta be. They gotta be able to trace the money somehow. Sorry, guys, can't get a loan.
So yeah, they're really good loan products. It's good alternatives, right, to have, because you gotta
have options, right?
You gotta have options. Yeah, you gotta have options.
What is asset depletion?
That's the one. That's the one where you have right. If you have like liquid money in the bank, like 500, $500,000, and your loan amount is 400,000, and you have it's having enough assets to cover the mortgage. Like you have 1.25%, 1.25% to cover the mortgage. in stocks, in bank accounts, stuff like that.
What about real estate? If you have other real
No,
estate,
no, it's got to be liquid.
Liquid.
Liquid. It's got to be
What
liquid.
about gold, diamonds? That's counted.
No,
too?
liquid,
No?
liquid
No.
dollars.
Sorry,
Diamonds are forever.
He said your diamonds are not gonna work.
Liquid
Diamonds, guys.
All right.
Sorry, guys.
But DSCR, you said, can be anywhere two, 3, and up, more percentage.
All of these loans.
You know, so a DSCR could be like, I don't know, a few 8, 7, 8, 9.
Well, no, I have a DSCR with these guys right now.
7.
7, but it's a 5-year. It's a 5-year on.
So depending on the credit and depending on the property itself.
Correct. Right. I mean, this is a 2-family investment.
But can you get a 30-year DSCR?
Yeah.
Okay.
Yeah.
Okay.
Wait, it would just be
I
higher.
actually got a DSCR once. Remember what Velocity Bank?
Oh yeah.
Velocity Bank,
Yeah.
It's 30 years fixed.
Yeah.
699.
Oh
It
wow,
seems like a good product.
that's great.
Oh, but it's great, but when you did a loan, you did a loan for me. Remember you?
Oh, I did the loan.
Yeah,
I did that loan.
You did a loan for me. You know, you were the quarterback.
Oh, that's
And I
right.
mean, that's 3 years. 3 years ago.
Wow. Susan. It was Susan that we did that with.
Susan's still around. Yeah, I spoke to her, man.
Wow.
She doesn't work with Velocity now. She works with another bank.
Oh,
She's
interesting.
like, I have some great programs.
Oh,
also.
interesting.
Yeah,
Interesting.
You should get in touch with her. She's
Interesting.
connection, bro.
Okay, cool. So, any more questions about this stuff?
I think it makes sense.
Yeah.
Josh Kelman. Oh, New York State of Mind. Okay.
Now, for the 12.
Thank you, Josh.
12 or 24-month bank statement program versus a profit and loss for the 2 months of bank statements, is your rate looking pretty similar?
Yeah, which one's better?
Programs?
That, I don't know.
Okay.
But I believe that the 12 to 24-month bank statement program is going to get you a better rate.
Yeah.
It's cheaper,
Yeah.
probably.
The P&L
Yeah.
More
makes
solid.
sense.
It's more solid.
Yeah.
And I think that's really how it works in the mortgage business.
Mhm.
The more solid, I mean, just think about it.
Safer. The
Think
safer
about it.
deal for the bank.
Yeah.
If you're lending money, someone's coming to you for $500,000, $1 million. Say, Monica, who are you going to be more nicer to?
Mhm.
You be nicer to the person who's got the better credit, got the better job, got putting more money down, right? You're going to be more lenient in your terms,
Yeah.
right? And if someone who's like,
Shaky.
although what's so interesting though, it's interesting because you have programs like the FHA program where you could put down 3.5% and buy a 2-family for $1 million and have credit that's not top tier credit. And we'll still give you, and you'll still get a really good interest. The interest rates on FHA loans are very, very competitive. The downside is that mortgage insurance, is that month, the upfront and the monthly. But hey, you buy a $1 million property for 3.5% down, multifamily.
Yeah.
Can you get the grants on it as well?
Yeah.
Yes, you can.
If your income is certain, whatever.
Yeah, you can. Yeah,
But
yeah, you
sometimes
you can mix grants with different programs. Yeah.
On what about the no-QM loans? Can you get grants on those?
I doubt it.
I don't think so.
That's a great question,
That's an interesting
and I highly doubt.
My goal is to ask.
Yeah, see,
good
he's trying to
five
stump me.
questions.
That's what he's
Good
trying to do.
five
This guy, he's trying
questions.
to
He doesn't know.
stump me.
You know,
And there's plenty of things I don't know, but I'll tell you.
it's interesting because I would, a grant for sometimes you would get a grant for maybe like a lower income person who's trying to get a home loan or maybe they have some type of whatever. But like if you're buying an investment property to make money and someone giving you a grant to do that.
You're not right. She's,
No,
Monica's 100. You're not. No, Monica's 100% right. You're not getting anybody. If anybody knows this, please let us know because I'm pretty darn
I
sure
don't think so.
nobody's giving you a grant if you're buying an investment
And
property.
that's upsetting to me, right? In a way where you as an investor, you're not really incentivized to invest more.
Depreciation is your incentive.
Yes. But I mean, in terms of like getting the loan.
Yeah.
I'll give you an example. I just did solar panels on my house.
Yeah,
That's
but you
that.
should get a break for
I
that.
know. Listen to this. I still gotta talk to my CPA. So I was told by the salesperson who sold me the thing because that thing cost $100,000. He told me I'll be getting $30,000 in grants. In grants. However,
Not if you're an investor.
and then I did find out not on investment. So, why should I, as an investor, which I do invest to generate income and opportunities for other people, I can really reap the benefits or I don't get the help.
So
Maybe it's a write-off.
Okay, I got to speak to my CPA. My CPA say no. Only primary residents you get federal tax breaks.
Yeah, but it's a business expense.
Yeah, so I will write up the whole thing.
Mm-hmm.
Yeah, that's not a problem. But what I'm talking about,
The
they give you credits out of $100,000. They'll give me almost $30,000. Write it off.
yeah.
Which, as a matter of fact, they've write it off from the beginning. And you got 12 months to claim it and give it to them. And if you cannot write it off, now you have to either come up with a $30,000 out of pocket, or you pay the loan for it for the $30,000.
Interesting. It's interesting.
Very interesting.
Yeah.
I find it hard to believe that they don't offer any kind of incentive for investment property solar panels because they are pushing
They should.
green
Yeah.
living.
Yeah.
Even if it's a primary or
Yeah.
I would double check that.
Yeah.
Yeah. Yeah.
I
agree.
mean, maybe it might not be as large as a primary, but I don't think it's completely zero.
There should be something. I mean,
Yeah.
you got big companies like Amazon and, big corporation,
Mhm.
which, they should want them to go solar, right? They should want them to go ecological. I'm not saying I'm as big as Amazon.
You're not?
Not yet. Not yet. Not yet.
Like, yeah.
I will be one day. Okay. But I mean, yeah, they should incentivize investors as well. And I mean, back to the grants, right? They maybe have some program in certain neighborhoods.
I mean, we should look that up. Should look that
It
up.
does sound interesting.
That's it
That's
for
pretty much it,
non-QM.
guys. So
That
guys,
was good. That was great.
it was so good. I mean, I got so much value out of it, Pete. Thank
Always,
you.
Every time.
Guys, if you find a value in it, let us know. If you want Pete to be back, let us know as well. I mean, we always love
Please request me, please. Come on.
I'm requesting.
Okay, so we got one vote so far. But guys, I hope you find this helpful. It's always a pleasure. This is what we try to build on this channel, on the YouTube channel, to really bring you a value a little bit outside the box, something you can actually take, you can comprehend it, and you can go out and apply it.
And if they have, if people have, topics that
yes,
they like
yes,
covered, please, let John know.
yeah, let us know, guys, in the comments if there's some topics you want us to cover. Something you have questions about, definitely put in the comments below. Let us know, and we'll try to bring it to you. Pete,
Cool, brother.
thank you, bro.
Thank
Appreciate
you.
it.
Appreciate you.
Pleasure, guys. Peace out.